Now we can't pray.
It's just me.
All right, we're streaming.
She said, just one weekend, she said, it's a very different job now.
So you're gonna open the meeting?
Very different. All those people you have coffee.
And we're all set.
Suddenly.
If you want to open the meeting, or I can do it.
Thank you.
There she is.
Okay.
Thank
Yeah, like to open the special work session for the City of Geneva IDA to go over the cost benefit analysis for the Lakeview project. With that, I guess we get started. Adam, you got it from there.
All right, thank you. So we have Michael Indolo here from MRB Group to kind of walk us through this cost benefit analysis. So I believe we'll go through that, and then questions along the way. We can ask those and we'll get them answered. And that's all that's on the agenda for today. There is no executive session scheduled, but if it's needed, we can certainly entertain a motion to go into executive session. So for now, I'll turn it over to Michael Indolo from MRB Group.
All right, great. Can everybody hear me okay?
Yep.
All right, good. Michael Indolo. I have been involved in upstate economic development for the last 20-something years, doing all kinds of analyses and plans, including for the city of Geneva over the years. And back in the old Empire Zone days, if anybody remember those, I appeared in front of the Empire Zone board a number of times about projects that came up. So I have a bit of a history working in Geneva on many projects. I've been at MRB Group for 6 years now, and MRB Group produces this tool, the MRB cost benefit calculator, for roughly 42, 43, 44, something like that, IDAs around the state, right? So this is a tool that most of the active IDAs use. And it's really set up to fulfill your obligation under general municipal law with respect to conducting a cost benefit analysis. I only kind of preface this by saying you may have questions about why do we do it this way, and you may hear from me more than once, this is the way we do it because we need to do it this way so you comply with the law. Okay? All right. But basically the law lays out a few things. It says that the IDA board must contemplate the costs and benefits of the project as part of its deliberation, right? And costs are defined quite explicitly in the law as being the costs of the tax abatements, okay? And the tax abatements themselves are what is the cost of the tax abatement, right? And I'll go through this and I'll explain how we calculate it. But the cost of the tax abatements are the difference between the tax that the project will pay under your abatements and the hypothetical tax that would be paid by the project if it moved forward, but without your abatements, right? And this is an example of like, well, why you do it this way? I mean, the project's not going to happen if we don't give them the abatements, right? So why are we calculating the difference between this hypothetical thing that can't happen and what they're going to pay? And the answer is we do it because that's the way the state requires it to be done according to legislation, right? So again, we're going to calculate these things out as if the project is happening without your assistance, and what will happen if the project doesn't move forward. Does move forward with your assistance. And then the benefits are what are the jobs? What are the wages? What are the other benefits associated with that? And what are the fiscal benefits? And the fiscal benefits are expressed as, for example, the difference between this particular project site, if the project doesn't happen at all, versus what it will pay in tax if the project happens, okay? And those are the benefits of the project, right? So in the first instance for cost, we're saying IDA benefits versus the project happening without IDA benefits, and the benefits being what happens, the difference between IDA benefits and no project at all, right? So that's the basic framework of the analysis. So before I go through the calculations or what this particular spreadsheet says, and I'll pop it up on the screen so we can all be looking at the same thing at the same time, I just want to stop there for 1 minute and just ask if there are any questions about the framework or what we're trying to get done or anything like that.
Michael, this is Adnano. If in fact the project goes through, how much, and I don't, unless I misunderstood what you just said, I don't see what would they pay in taxes without the pilot? Because I think your property tax without the project is based on the current
Assessment, yeah.
building being there, no improvements made, no new building, no nothing.
Mhm.
What would happen, or what would be the amount if they took the assessment? Now, obviously, the $38 million is probably an overvalued. I mean, the building's not worth $38 million. There's a lot of fees and stuff in there that are being added to that cost. But let's say it's worth $25 million. If they were to build it, we didn't give them a project, how much tax would they be paying? I mean,
And you did not give them a pilot, right? Is that what you're
did
saying?
not give them
Yeah.
the pilot. I mean, that's a calculable thing.
Yeah.
So now that's not saying they wouldn't get a tax abatement someplace else. You know, I doubt that they would get through the county, but I believe there's some other state abatements they would get for being a nonprofit. So different programs, different abate. But assuming that they had if they built the project and we didn't give them the pilot, that would be a substantial sum, right? I mean,
Yes.
based on, I mean, if the assessment now is only 400,000 and or 500, whatever it goes to, and this would be 25 million. I mean,
Yeah.
there'd be a huge tax there. I understand why they need the abatement,
Yeah.
but we're not actually, it's not apples to apples. I understand that, but it is
Yeah.
also that's a number that could be put into used against us.
Yes, that's right.
If they in fact gave, went ahead with a project without our pilot, then the city would actually benefit from that.
That's right.
Unless they are able to get money else or abatement elsewhere.
Yeah, Michael, this is Steve Meyer from Harris Beach. Just for frame of reference, I believe that this project would qualify for 581A.
Yep.
So just as kind of a frame of reference, I believe that's the provisions that Ann was speaking of.
Is that 581A the same amount? Is that the same? What is the amount of that, Stephen? Do you know?
I don't know off the top of my head. It is based off of, I believe, some sort of income approach.
Yes, yeah.
Based on that. So without having actual pro formas and all that stuff in front of me, I couldn't give you an accurate number.
So it would be similar to what they're asking our pilot to do then, which is the
Yes.
pro forma. Yeah, okay. All right, so maybe that's a mute discussion.
But it's a great question because the way the analysis should be conducted is comparing the amounts they'll pay under the pilot against the amounts they would pay if there were no pilot. But we should contemplate if there are other abatements they would be eligible for, right? And compare the pilot amounts to what they would be eligible under the most generous program, right? So for example, and this does not apply in this case, but 45B is a very common real property tax exemption that a lot of commercial properties would be eligible to. And in those cases, if you're doing the cost benefit analysis, you should really be comparing the pilot payments against what they would be paying if they just simply went after a 45B assessment abatement, right?
Yeah.
Because we're trying to see what's the differential that the IDA is providing a project.
Correct. That's
So-
correct.
So great question, and it brings up a really good point, right? That that's the framework of our analysis, right? All right, any other general questions before we move on to the specifics of this project and how things are calculated? Okay. So I believe what you have, I think you guys may have this in front of you right now, but there are two output pages, okay? And I'm going to pop this up on the screen here. And this is what is put into the docket, right, of this project, right? So your staff will produce the analysis, will print this off, and will provide this in the docket. It becomes part of the public record. It gets posted to your website, that kind of thing, right? And I'm going to show you quickly that, and I believe, like I said, I think you guys have that. Oops, I need to have sharing requests approved so I can share the screen, if you would, please. Okay, thank you.
You're welcome.
All right, here we go. So hopefully I do this correctly here. You should be looking at a spreadsheet right now. Okay, I'm going to back out of this. Can everybody see that?
Yep.
Okay. So these are the impacts this is the 2-page item that goes into the docket. This top box here are the temporary impacts related to construction. Okay. I'll explain that in a second. The second box are the ongoing impacts related to the project year after year. Okay. So the construction. One of the things we ask is what's the total dollar value of labor and materials that is going to be sourced locally, however you define local, right? And that's what you ask the applicant, and they provide that information. That gets put into a model, and I'll show you in a minute how that gets put in. And that produces a number of jobs. It says basically, if you have that much construction happening locally, you get this many direct jobs. Those are construction jobs, okay? The model, and this is in the background happening, the calculations are happening, will show how many indirect jobs are produced based on this number of direct jobs and this amount of spending, okay? So you have 28 construction jobs, but there's some recirculation that happens in the economy, right? That construction company is going to make certain purchases in the local economy, right? They may go rent a piece of equipment, for example, right? And bring it to the site. They may buy building materials locally. They may hire a local, whatever it is, right? And so those are the indirect jobs, the business to business purchases, number one. And number two, some of those construction workers will spend some of their wages locally, and that'll create jobs for your grocery stores and your doctor's offices and your whatever it is, right? So that's the 6 jobs in there. That's the indirect jobs that are resulting from business to business purchases and employees spending their wages locally. So what we're saying is there's a total of 34 jobs. And it's those 34 jobs, direct and indirect, are earning 1.8, $1.9 million. Okay. That's during the construction period. During the life of the project, and this can be very confusing to folks, so just bear with me here because this is a housing project. It's a lot more straightforward if it's like a manufacturing project. There are 2 sources of direct jobs. One source is how many jobs the applicant is going to employ on site for things like property management, property maintenance, that kind of thing, right? And I believe in this case, Adam, correct me if I'm wrong, but I believe there's 2 jobs associated with that. Is that correct?
I believe it is too, yeah.
Okay, thank you. The rest of the jobs, and this is how it works for housing projects, the rest of the jobs are related to household spending, right? And the concept here is, but for the project, these housing units would not be available in the community. And therefore, this household spending would not be in the community. These people would have to live some other place, right? And they'd be spending their money in Canandaigua or in, I don't know, Victor or wherever, I don't know, right? And so but they're here in Geneva, and therefore they're spending a good portion, not all, but they're spending some of their household income locally, and that's creating certain jobs, right? So that's 24 of those 26 jobs. And you have 8 indirect jobs. Again, that's business to business purchases and employees spending their wages locally, for a total of 34 jobs. Over the life of the pilot, right? Not for a single year. This is over the entire life of the pilot. That's $68 million worth of wages that are going to direct and indirect jobs. Okay. Those are the economic impacts that the model is showing. What you see here in figure 1, 2, and 3 are just graphical representations. That's all it is, right? It's those same numbers shown in graphs and lines, okay? So I'm going to skip over them, and we're going to go to the costs and benefits of the project from a tax point of view. In this case, our property tax exemption is valued at $15 million, okay? That's the difference between what is input into this model as the pilot payments and what is otherwise the otherwise applicable tax, i.e. if the project moves forward and it's fully taxable, right? The difference is 15 million. I believe there's no sales tax exemption showing and no mortgage recording tax exemption because they're getting that sales tax and mortgage recording tax exemption by virtue of some other mechanism. And Adam, maybe you have more detail. I don't know exactly how this is happening, but maybe it's happening through the Housing Trust Fund or do you have any detail?
They have other sources for that. You're correct. Yep.
Okay. So the IDA doesn't have to worry about that for your cost benefit analysis. They're getting an exemption, but it's not from you. So you don't consider it as part of this. Your local benefits are the $1.8 million in temporary payroll, the $68 million in ongoing payroll during the life of the project. Your increase in property tax revenue, again, is if this property is not improved, what does it pay? What does it pay in pilot payments? What's the difference? That's the increase in property tax revenue. You have the sales tax revenue associated with ongoing jobs. So that $68 million, right, of payroll, some of that's going to be spent locally. Some of that is going to be spent on goods subject to the sales tax, right? So this is the model's estimate, about $500,000 over the life of the pilot. And then the state benefits, which are calculated based on some approximations around income tax and sales tax for those same things. We do discount those into the future. And this is a complicated concept. I'm happy to discuss it if you are interested, but basically we say $1 today is worth more than $1 in the future. We use 2% to discount that back to the present, okay? So we have the nominal value of all the benefits, $75 million, and the discounted value of those benefits, because you're going to get them in years in the future, is 55 million to both the state and the locals. Okay. So the last thing we have here is just the ratio. Your total local benefit is $52 million, you discounted, and your total local cost discounted as well is 11 million. Therefore, your ratio is 5 to 1. Okay. The state essentially has no cost because they don't get any property tax either way, and there is no sales tax exemption or mortgage recording tax exemption that the IDA is offering. So you have essentially an undefined ratio, right? There is no cost, so the benefit is just all benefit for the state. You're at 5 to 1. Now, one of the things that comes up all the time, and I just want to get right out ahead of it, is to say there is no minimum benchmark. Like, it's not that you have to be at 1 to 1 or 2 to 1 or 10 to 1. The state does not define a benchmark. It doesn't say you have to have a certain amount of benefit as compared to your cost. We provide this ratio because sometimes it's a little easier for an IDA board to understand and compare one project to another based on how much incentive they're giving versus how much benefit they're receiving. But I just want to be very clear. There is no minimum ratio. Okay. So these are the outputs that you're looking at. I'm going to stop there for questions because I can go into kind of how these are calculated and what the inputs are and how that gets inputted into this model. But I'll stop there for now. What are your questions or comments about this so far?
Hi, Michael, Josh Kane. I do have a couple handfuls of questions related to the CBA. The first piece is, and I couldn't really see up on the board for in-region spending construction wise. Was that still a $3 million figure, or what do we have populated there?
It's $3.8 million.
Okay, so we did verify with the applicant that it's actually quite a bit lower because the application states that it's 10% of construction specific spending. So we should actually decrease that to approximately 2.56 million to reflect that. So I don't know if that necessarily changes the final outcome, which it technically should. I know that's more upfront from a discounted cash flow perspective, but I think we do need that adjustment there.
So it does look like, I'm just looking at this right now, the total construction project costs are 38 million. And so this is 10% of that number, but I believe what you're saying is that the 38 million includes things beyond labor and materials. Is that what you're saying?
Yes, so the standard application that the city of Geneva IDA uses is it asks how much spending is local in the county as a whole, specifically Ontario County, of course, not even specific to the city of Geneva. And so the application states 10% of labor, 10% of construction materials. So the project itself is costing approximately 25.5-ish million. So 10% of 25.5 million is 2.5 million versus 3.8 million.
Yep, it's a good point. Okay, so that'll have to be adjusted then.
I had a question. This is Lowell. What's the life of the project? Did you say like 50 years or the pilot? No, I mean,
The pilot is 30 years. That's what's assumed in the model.
Are you talking about the useful life of the property? Like, from
Yeah,
a
I thought that was
standpoint?
I thought he mentioned that as the life of the property. Is it in the equation at all or no?
No,
Okay.
it's the life of the pilot. We're comparing all of the benefits during the life of the pilot to all of the costs during the life of the pilot. Presumably, when this comes off its abatement in year 30, in year 31, they'll be fully subject to the property tax at that point.
Right. It just strikes me as the benefits seem inflated. I don't know, just they're big numbers of, and I guess I understand your calculations, but and what are they based on? Is that your experience of
No,
projects of this size?
it's not our experience specifically. It is we use a data focused, right? We use actual data on this. So I'm gonna hop to the input set. Right now you're looking at the output tab, right? This is what gets printed out for you in your document. I'm gonna flip now to the guts of the model, which shows the input tab. Okay. And so one of the things that the person who's entering in information, right, whoever's doing that, needs to put in a couple of things. And I'm popping in right here to new household spending. Okay. So we have a unit type and we have a targeted income. Right. So what we're showing here is that there are 53 units that are going to be in a lower income bracket, the 40 to 49,000, right? And we have 21 units that are going to be in a higher income bracket, which is the 50 to 69,000 dollars. Okay. These income brackets are not our income brackets. They are the income brackets that the Bureau of Economic Analysis uses for households. Okay. I'm sorry. Yes, Bureau of Economic Analysis. They also establish household spending patterns by these same income brackets. Okay. So we're taking, I can get you if you want it, I can get you the actual citation. There's a particular data set that we use that's published from the federal government that says this type of household spends this much on average on this type of good, this much on average on this type of good. We take all that spending pattern, right? And we say, multiply it by 53 households. That's how much spending is happening based on these households, right? And the same thing for the 21 units, right? Obviously, the 21 units are in a higher income bracket, so they're spending more, right? That is what we input into the Lightcast model, right? That shows what are the jobs that result from that? What are the wages that result from that spending, right? So one of the things that we point out is we again say like it's critical that people view this as, but for the project, there would not be these 74 units of housing in our community, right? That this isn't just substituting 74 units for somebody else. This is adding 74 units to the mix, right? This will increase the total unit count in the city of Geneva by 74, all other things being equal, right? So what we're saying is, if you multiply that out by the spending pattern, when you add 74 units to the city of Geneva, you get 74 units of household spending increasing in your community, and that's that many jobs and that much in wages. So yes, it looks like a lot of jobs, right? But it's not picked out of thin air. This is on actual data that we get from the federal government about spending patterns by household income bracket. Any other specific questions about this? Okay. I'm going to very quickly run through the other parts of the analysis. Some of it gets quite technical. It's probably not necessary for board members to necessarily have all those details, but I will just point out a couple of things. One is we enter total project construction costs. We say we want it defined under New York State Labor Law 22/4/A. That's that public subsidy board calculation that needs to happen. And this is because there's another module within this program that helps you calculate the percentage of total project construction cost. That's total project construction costs. That the public benefits as a proportion of that, so that you know whether or not they've hit the 30%. In this case, the entire amount was applied, the 10%. It sounds like we need to adjust this so that it's just that amount that's related to construction materials and labor as opposed to total project costs. So we'll make that adjustment. We apply that to residential projects, right? And that's how we calculate the construction impacts, those jobs that are related in the construction period. I've already covered the household spending here, so I'm going to skip over that section. And the last thing that we have here, oh, I'm sorry, I gave you the wrong job numbers. I'm sorry. I realize now that I forgot about the the other folks that are associated with this, which is the 5.5 jobs that are about supportive services to here. So when I spoke earlier about 2 jobs, it's actually 9.5 jobs, because you have your property maintenance and management, but you also have these supportive services jobs that are associated with this project. So there's 9.8 of those jobs. We put those right into the model for lessors of residential buildings, residential property managers, and there's mental health and substance abuse counselors, right? We say these jobs, earnings associated with those jobs. This is from the application. And then that gets us to total amount of direct wages being paid related to that. And then the fiscal impact assumptions, these fields are blank because there is no sales tax and no mortgage recording tax exemption from the IDA. We have a 30-year pilot. We're using a 2% escalation factor and a 2% discount rate. And then this is how we calculate the benefits and the cost of the pilot. Again, it's property tax without the project. So we've modeled out here, what will that site generate in property tax absent a pilot? What are the pilot payments that would be due? And then what's the property tax on the full assessment, right? It's the difference between these two, which is the benefit, and it's the difference between these two, which is the cost, right? Again, it's like, hey, if this thing were built, paying full tax versus the pilot, that's the cost. No project versus the pilot, that's the benefit. And then we have a catch-all down here. There may be, in some instances, there are other local municipal revenues, like if it's a hotel project, you may have hotel occupancy tax, right? Sometimes there's payments to private individuals if it's like a lease situation for like a solar project or something. And that's pretty much it. You have some notes, and then you have a couple of the yes/no questions, but that's the basics of the model and how things are calculated. Any questions or discussion about that part of things?
I have one more, I think. If this were a smaller project, say 50 units,
Mm-hmm.
then the benefit would be proportionately less.
Yes. Yep. All right.
Can I
Sounds
ask
like we've.
I'm sorry, I was
Go ahead. No,
unmuted.
please go ahead.
This is probably not even related to this discussion, but I am curious how we came up with a 30-year pilot. Is that common for a project like this? It seems like we were just at an IDA meeting and all the pilots seem so much fewer years. Is there a reason we landed on 30?
I have a speculative reasoning for it, but I'd rather pass this off to Adam in case that discussion happened with the applicant as to why the 30-year
Yeah.
ask.
It's Jan, it's the term of their regulatory period.
Yeah.
I see.
Which is very
And it's
typical.
and it yeah, it's
Mhm.
as Michael just said, it's very typical
Mhm.
for pilots to coincide with that regulatory period.
Great. Thank you.
Yep.
They were talking about 7, 10, 12-year pilots in the seminar we went to. Not once did they mention anything over, say, 15.
That was 12. Max was 12.
Pardon me?
The maximum pilot that they discussed was 12.
Yeah, yeah. So we're driven by the conditions of their loan, or I don't understand that exactly. So
I will say, and in these types of housing projects, especially ones that are getting qualified for LIHTC, this is not uncommon. I would say, especially downstate, you see this a lot with a lot of the affordable housing that's going on. There's a decent amount in Ithaca that have done this. But yeah, I mean, each IDA, again, remember, has their respective UTEPs, which they can set out, the maximum number of years. They could have different pilot terms for, manufacturing projects, housing projects, renewable energy projects. So that's up to IDAs. Like for example, Steuben, I believe they're very broad and that they permit 20-year pilots.
Mhm.
And they don't differentiate amongst industries. It gives them a little bit more flexibility. Genesee County, for example, they kind of do roughly the same thing on market rate stuff. They'll do, it could be a 10, 15, and there's other projects that qualify if it's manufacturing, might qualify for a 20-year abatement. So it's kind of, I wouldn't say there's any uniform approach regarding pilot terms. In my experience, I have not seen a 7-year pilot. The lowest that I've seen in the years that I've been at Harris Beach, it's usually around 10 is kind of the shortest term. But in short, the 30-year term is not unique to this project.
We did also ask at our last board meeting the reason for a 30-year pilot. And we did also verify that it's to make their application to the state stronger versus a need of the actual development. And we did actually verify that a couple of times. So I do think that that is noteworthy as well, especially when we're discussing pilot lengths in relation to other municipalities and what they are doing.
Yeah, one thing I will add on that front is really they kind of go hand in hand. Our firm also represents affordable housing developers downstate as well. And more often than not, when they're making their application, yes, having approvals from, for example, a local IDA, approvals for a pilot, certainly help their application. But when I say they go hand in hand, without the approval of a pilot, chances are they do not get the incentives or the level of incentives that they were contemplating when they make their application, which in turn just totally upsets the capital stack in that front, which may make the project economically unfeasible. So it kind of, like I said, it kind of goes hand in hand. It certainly helps their application, but without that, they may not get approved when you're talking about LIHTCs, and if they're especially if they're going for a 9% deal, those are extremely competitive.
Yeah.
So those are all kind of the moving parts that, at least on the developer side, what they're going to be tasked with.
Stephen, maybe you could answer this question then. There's development fees built into that $38 million that total quite a bit. It depends how you look at them, which ones, but there's professional fees and there's also monies paid back to the Lakeview and CDH or CH, whatever the
CSD.
Yeah, CHD. They have development fees that they get
Yep.
back, and they're substantial. Which would mean that the amount that we're giving them in tax abatement could be covered with that, couldn't it?
Well, it's going to be based off of the actual pilot itself is going to be based off of, and in this case, your valuation is like I said, they're either going to be under 581A or under the pilot. And that's based off of an actual valuation of the property itself, not necessarily quote unquote total project costs,
Okay.
which their
All right.
sources and uses may include that quote unquote developer fee.
Got it. Okay. So then really we should be looking at what the building's worth and what it's going to perpetuate tax wise, not the project number. And I know Michael's already conceded that point. So, okay. That's good. I mean, there's a lot of soft costs and I think the agency has already identified most of them, maybe not all of them. It's a big amount of money. Like, I think, Josh said that, it puts it closer to a $25 million or less than $30 million project, which is more in line with what construction costs would be instead of that 38, because that's come up in the public meeting a number of times that each unit is costing $570,000 each, which is for a one-bedroom apartment a substantial amount. But it's being driven up because of these other costs, soft cost or whatever you want to call it. And so would it make sense for us to only be looking at the construction costs instead of the project costs that they're identified as? Because if we lower the construction cost, that would also lower the cost benefit, correct?
Yes, it would.
Yeah.
You'd have fewer jobs during the construction period, and you'd have less in wages being paid out during the construction period. Yep.
Right. So, anyway, all food for thought, I guess. How we're gonna approach this. All right. Any other questions before we close the meeting?
I do, yes. So on the tab, and I know we briefly talked about this, it's the output tab, the fiscal impact tab. So under the nominal value, it goes, the first one is to private individuals, then to the public, then of course, state benefits. What are I tried looking for cellular references, but I couldn't find the underlying assumptions for these cells. Do we know what underlying assumptions we have other than, say, an employment figure to generate a $69 million ongoing payroll?
The $68 million, you 68,000,007, is that what you're looking at, ongoing payroll?
Yes, as well as the temporary piece as well.
Yes, right. And so your question is, how do we come up with that?
Yes.
Okay, so there's two sources of that. I'm going to flip to the input tab. One of them is this, which is those jobs that are on site, those 9.5 jobs that are on site.
Mhm.
We know how much they're being paid. That's in your application, right?
Yes.
So that's 441 times 30 years, right?
Correct.
The second set of earnings are from the housing units that I described earlier, which is to say all that household spending, right, that's coming into the economy is going to generate jobs and wages at, local businesses, right? And it's that's the wages being paid there, right? And then we have the indirect jobs, which are the business to business, types of impacts, and the employees spending their wages locally impacts, right? That adds another layer on top of that. So there's three different layers. And yes, those calculations are not they're not apparent if you just simply look at this sheet, right? It's quite complicated, and it's on a couple different sheets that are hidden, right? You don't see them.
Right. So essentially, the $68.7 million figure is the payroll generated from the property of 441,250 plus local household spending, which is 2.187 million times 30.
Yes. Plus the indirect impacts, right? Yep.
Okay. So then related to that piece, when we go to and I know you touched on this, the ongoing operation piece where it says direct jobs are 26. How did we get to 26 again?
Okay, yeah, and so I had given you the wrong numbers before. It's 9.5 is what the applicant is saying is happening on the site, right?
Yes.
Between the property maintenance and the supportive services, right? So if you take that out from this number, you get to 16.5 jobs being associated with that household spending.
Okay, so the total jobs is reduced from 34 to 16.5 on the ongoing operation piece.
Sorry, why are you reducing it?
I thought you just said that there was a mistake in the numbers and then it should be 9.5, and you mentioned something about
No.
16.5.
I misspoke earlier when
Oh.
I said there was only 2 jobs on site. There's 9.5 jobs on site. So the
Okay.
26 jobs you're seeing here, 9.5 of them are on-site jobs, supportive services and property management. And the balance of that 16.5 are jobs that are associated with household spending.
Okay. So then the indirect piece, I thought the indirect piece was related to household spending. So such as, which I could be also incorrect in that, where I'm going to a restaurant or I need to go to, say, urgent care or something. So if local jobs generated from household spending is covered in direct, what's included in indirect?
So the answer to that is yes, they're in the direct column, right? So the indirect are business to business purchases, right? So in this case, and this gets really confusing because we're talking about 2 sources of direct, right? So you have the property management and supportive services folks, right? Business to business purchases they make, right? And secondly, business to business purchases made as a result of the household spending. So you have someone who goes, a whole bunch more grocery store spending, right? So that grocery store creates a job, right? that grocery store also has to buy inputs, right? It's going to buy groceries from a wholesaler, right? So there's a second round. That's the business to business purchases. And that grocery store employee is now spending a portion of his or her wages locally as well. So that's also a portion of the indirect, right? So that's all what's wrapped into the indirect job number of 8.
Okay. And so those assumptions are based off of, is it the same like federal data
Yes, it is. Yep.
that we used for the local household spending? Okay.
Well, it's a different data set, but yes, it's federal data that is on the business to business purchases. It has to do with a thing called a production function, which is horribly named, but it's basically how do different businesses purchase from other businesses, right? It's that kind of crosswalk between each industry. What does it purchase its inputs from, right? That's also from the Bureau of Economic Analysis.
Okay. And is that data just out of curiosity, is that broken down by region or is that a national statistic or is it statewide or how is that data broken down?
We use your county specifically.
Our county,
right?
okay.
Yeah. So, and I'm sorry, let me, the Lightcast data provider that we use, we get data specific to your county, right? That we load up in the background of this model, right?
Okay.
And then this calculates based on your specific multipliers and factors, right?
Mhm.
Which is wages per worker and output per worker and earnings per worker, right? That's also specific to the county.
Okay. And so then along the same lines, it must be from not necessarily the same data set, but a similar data set for benefits to the public in terms of income tax revenue, sales tax revenue, and the like for public and state.
That's our calculations that we make in the spreadsheet. So for income tax revenue, we apply a marginal tax rate to earnings, right? The state's marginal tax rate.
Okay.
And then for sales tax revenue, we make an assumption that 70% of spending happens within the county, and that 25% of the 70% is on goods and services subject to the sales tax, right?
Okay.
And then we apply the county's tax rate and then the state tax rate of 4% and the county's tax rate to come up with the state and county's sales tax revenue.
I have just another thing. A good portion of the people that be living in this development seems to me like they're recovering from problems, whatever it is. And your calculations assume that they're all working. Is that true?
They are assumed to be in the income bracket that is provided. So working or not working, that sort of silent about that. It's whatever income bracket is put into the model, right? That's what we assume they're spending at, right? So so your question, I think, might be, or I guess the sense of your question is to say, should we be adjusting downward, right? Because someone in a supportive service unit is going to have less money to spend, right?
Or
Is that what you're saying?
Yes, and their source of funds. Maybe they're getting grants to survive, just money to survive rather than working. I just thought maybe there should be a separate calculation.
Yeah.
Maybe not.
So
I don't know.
what we had to do to get to this, right, is we had to say, what is the income bracket that's applicable across those across the units in question, right? So you can see in here, I want to go back to this. for one unit type, which we said are the folks that are at 50%, 60%, and all of the supportive units, right? We're saying are in this income bracket, $40,000 to $49,000 a year, right? And the remaining units, the 27 units, are in the next bracket up, which is 50 to 69,000. Okay. How do we get at that, right? Well, if you look at 50% of AMI and 60% of AMI, right?
So,
AMI.
sorry to interrupt. We can't see it on the screen. Can
Oh,
you
I'm
pull
sorry.
that
I
up
thought I
again?
was sharing my screen. Pardon me. Okay. Sorry. So I'll go back to this. So this is saying the 53 units up here are all the supportive units plus the units at 50% AMI and the 10 units at 60% AMI, right? And then the rest are in here. So there's a difference. You can see this is 40 to 49 and this is 50 to 69, right? So what we try to do is we try to calibrate the income bracket based on a reasonable assumption, right? For the average across those 53 units, right? So some of them are in the 50% bracket, some are in the 60% bracket. We don't know the supportive bracket. We don't know, like there's not an income threshold for that. And you might be right. Like it's possible that many of them are unemployed or underemployed or only, partially employed, right? But one thing to keep in mind is that 50% and 60% of what? And that's area median income. And in your case, area median income is Ontario County median income, median household income, not individuals' household income, right? So the numbers that we used for that, okay, it gets confusing because they're county income numbers, but they're also based on generic households. We did our best guess to say across all of those different units, where's that median income falling, right? 40 to 49,000 is what we thought based on those income brackets. But you're right, we don't know what the 37 units, we don't know what their income is, right? And income includes anything. It can include Social Security income, it can include grant income, it can include supportive income where you have a job that's a subsidized job. It can include transfer payments, right, as well. So that's a harder one to get at. If the IDA felt more comfortable being a little bit more conservative than this, we could certainly knock it down to the next income bracket, the 30 to 39,000, right? Again, that applies to the 50%, the 60%, and the supportive housing units, right?
I guess for me, that makes a little more sense.
Okay,
I
we'll be
don't
happy to make
know.
that adjustment. Yep.
I don't know what other people think.
Okay, do we have any other questions from Michael on this before we close the meeting? It's been an hour now, so.
Just a few more brief ones.
Before we move on from that, though, I just need to know, does the IDA board want me to adjust that downward so that I can reissue them? I can reissue the findings of this if you like. I just need to know if people are comfortable with that.
I think so.
Yeah.
Okay. All right. I'll do that then. Thank you.
I'll try to make these quick. 2 minutes, 3 minutes. Okay, so the implied discount rate to the outcome is 12.94%. Is that also a federal standard?
Oh, you're looking at the MVP report. This
Yes.
is not the discount rate. That is so we don't have, I would say don't even worry about this spreadsheet because this is a rent regulated affordable housing project. The public subsidy board test is not applicable to this project, okay? But just to answer your question, that number, that percent, is the value of all benefits as compared to total construction project costs as defined in the law, right? So you're saying that number hits 13. If you hit 30, you're subject to the public subsidy board, right? But
Okay.
this is, in all cases, this is not applicable because it's an affordable housing project.
So the public subsidy board test is not applicable to this because of the type of project? It's
Correct.
residential? Okay.
There's some carve outs in that law renewable energy projects, affordable projects, historic renovations, all those kinds of things are not applicable to the test.
Okay, and so then again, the 12.54 is based off of federal.
The ratio of all your benefits
Okay,
to the construction project costs.
okay, because I thought that was an input
Nope.
from the 2025 discount tab, like it says even like golf courses, industrial lodging, so on and so forth.
That is that number up here, the B2, cell B2. What discount rate should we use? So
Okay.
that one was at 8.5%, but this is just what's in the model when we send it out to people. You adjust that to whatever you want it to read. But
Okay,
we didn't even touch this tab because it's not applicable, right? So
okay,
we didn't make any adjustments to this. We didn't do any data input into this at all, right?
okay. And then the last question is, a part of our UTEP, we should be considering potential increases in fire safety and public safety costs related to the development. Is there a place where we can include estimated costs associated?
We did not include those, but there is a way to do that in the model. All right. And this is getting into sort of an advanced technique. But what you would do is you would include that as negative local municipal revenue, right? So if you said, hey, I think this is going to cost our local fire department net is going to cost our local fire department 60 grand a year, right? Or whatever the number is. I don't care. Ambulance district, I don't care, right? You would put negative 60 grand in those years, and then the model would contemplate that as is essentially like a negative revenue. It's the easiest way to do it.
Okay. Can we look into doing that for the CBA? Or how does that process go for this?
If you tell me the numbers, I can put it in there, right? We can certainly put it in there. Now, you're getting a little far afield of the IDA mandate, okay? So you just be careful. You have to be a little bit careful about this, because the way we like to describe it is that there are certain things that are in the purview of a planning board, for example, right? Or in the purview of the city council with respect to zoning and so on like that, right? And the IDA does kind of have to stay in its lane, right? And so you wouldn't want to start moving into a planning board's role where they're going to undergo maybe a comprehensive seeker analysis of the costs of municipal services, provide that kind of thing. Like I would just give you a little bit of a note of caution going down that path.
So planning board will look into associated costs as part of seeker for this.
They should. That's
Okay.
normally part of seeker.
Okay, and so then we can take that data and then put that in CBA, because a part of our UTEP is actually any deviation from UTEP. And I'm just going to quote it. It says, to the extent which the proposed project will require the provision of additional services, including but not limited to additional education, transportation, police, emergency, and medical services, fire services as well. So that's going to be a very valuable number for us to use as part of seeker, because that is actually, like at least in this case for our city's UTEP, that's actually a part of our purview.
Okay. I mean, yeah, if you're able to provide me those numbers, I can add them to the spreadsheet, and then it'll change the calculations.
Stephen, maybe you could answer, have you seen this done before that way, where it's part of this pilot consideration?
I have not. As Michael said, typically that is almost a majority of the time, if not all the time, left up to local planning and zoning.
Okay.
And again, without going into too much detail and explanation, getting into these types of topics, you have to walk a very fine line.
Yeah.
Because you could potentially open yourselves up to Article 78 challenges, litigation, and so forth, which
From the applicant. From the applicant. Yeah, okay.
Or anybody else, frankly.
Mm-hmm.
Article 78, as you all know, they're I call it, procedural challenges. So that's why typically I advise to leave certain stuff to planning and zoning, and
Mm-hmm.
To the extent possible, just try to keep the incentives and the discussion around the incentives tailored to the IDA.
I have one related question. And again, I have a feeling this is a field of our mandate as well. But, what we're hearing, and it's speculation, of course, is that this project would have a negative impact on businesses for reasons such as parking. I suppose that could go to zoning and planning, but just saying, and there's plenty of parking in Geneva, but people do park directly in front of where they want to be. And because of a mixed use housing facility in the middle of downtown and so forth, and there was, when we had our hearing, a letter delivered to us stating that the business owner was leaving as a result of this project coming in. So again, it's all speculation, but a lot of this is based on speculation, that will get that many people of whatever income level into the housing project and so forth. But so where do things like that come into play? And considering that if businesses truly were to leave, which I don't know that would happen, obviously, but if that were to happen, that's a financial impact. Who considers that? Does the IDA take anything like that, that kind of speculation into account, or does someone else consider that? And yeah, I'm just curious because it's a tough call for me as a new IDA member. And I want to stay within our lane, as we're saying. But the things coming to me, I could call them financial concerns, which is, I believe, what we have to be looking at. So I guess my question is that a field of what we have to, of the mandate? And if it is, who considers those questions?
I would say, again, especially when it comes to parking, in my experience, whether it be parking or traffic considerations, that's almost always dealt by planning and zoning. And typically local planning and zoning boards will want some sort of, whether it's a traffic study or a parking study, which I think one was done for this project. I don't recall. But typically they will want to see something like that. So they can see, it's not just the developer providing it, it's, a third party, who has, all the credentials to undertake such study. And then they usually provide that and present that to local planning and zoning and say, hey, here's, for example, on this project, here's the parking as it sits right now. Here's your utilization rates and so forth. And with this project, whether you are, you're at capacity or whether you're underutilizing parking, and then insert, project X, and here's how we think this will impact traffic or parking and so forth. So all that to say, again, typically those considerations are usually done by planning and zoning in conjunction with the seeker process.
But the impact on future businesses is if just having versus industrial or retail or whatever mixed like use with retail and housing. I mean, that's what we got the letter from the merchant regarding that they did not want a housing unit of this nature. It sounds like a not in my backyard argument, but that's nothing really to be considered. Is that correct?
I would say that the IDA, no. I would, my advice as your legal counsel would be to steer clear of those types of considerations. And again, I think with respect to this project, I thought the study, and Adam, maybe I'm wrong, I thought the study said that parking was actually underutilized in this case. But when it gets into prospective impacts of, okay, you have this project, our people, what's going to be the local impact to local business and so forth. Are people going to leave and so forth? Those are all, I would say, considerations that, one, I don't think, and Michael confirm if I'm, you can confirm or deny this. I don't think those are things that we could frankly build into a model because of how speculative something like that is.
Yeah, I have to 100% agree, and I'll take it one step further. You're gonna open yourself up to some
Right.
real difficult things down the road if you start going down that path.
Okay, anything else? Like I said, this has been a productive hour. Thank you, Michael. Thank you, Stephen, for being on the call.
Yep.
You're most
Um,
welcome.
I'd like a motion to close the meeting, please.
Aye.
A second?
Second, RJ.
I'm assuming we're all done here, right? I didn't see the screen. Okay. All in favor, say aye.
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 All right, so close. Thank you.